This year's Berkshire Hathway AGM also had its fair share of quotable quotes coming in from Warren Buffett and Charlie Munger. And I thought I'll just, while a lot of it has been spoken about, I'll just present 3 or 4 things that I thought worked beautifully for me when I looked at the AGM, till 1:45 I might add. So let me just head across to our video wall and try and bring you 4 or 5 of the key things that Berkshire Hathway AGM brought out. Now remember, the one important thing is that this AGM started with Warren Buffett laying out the importance of owning productive assets over a long period of time. He cited an investment made in 10,000 would have become about 51 million if you had held on to that money. But over and over, there was emphasis of why people should be holding on to assets for a long period of time. And now, the first thing that happened on the AGM was Warren Buffett's commentary on gold and why people should not buy gold. In that long piece that he went on to elaborate, I think the one thing that I took out was that he's saying that buying pieces of great businesses has always been better than buying non-productive assets like gold. And of course, there's this whole math comparison of what would have happened if you had invested the money in gold versus buying a productive US business and staying put with it the way you would have stayed put with gold. And yeah, the numbers were astoundingly different, so don't even get there. And I know people would argue that we buy gold for a lot of different reasons, but when Warren Buffett speaks, you listen, and boy, did everybody listen. So this was how it opened up. Then there were a bunch of thoughts and questions, and through all the pieces wherein Warren Buffett and Charlie Munger had said that buy into companies for long term, don't think about what's happening in the short term, don't think about wars and all. A lot of questions that came in from shareholders were regarding pertaining to the China and the US trade tensions. It was almost ironical. But since they were talking about what would happen over the long term, I thought this Charlie Munger quote and his reply was fairly interesting. The question was that what would happen to Berkshire Hathway 50 years out in 2068, and Warren Buffett gave his usual answer, but I thought Charlie Munger said very, very interestingly to a lot of younger audience, he said that those of you who sell the Berkshire Hathaway stock after we are gone, referring to him and Buffett, and try to do something else with that money will be worse off. Laying emphasis on the systems which are there in play at Berkshire Hathaway and how they believe that irrespective of what happens to Warren Buffett or Charlie Munger, the juggernaut called Berkshire Hathaway would continue to roll on. This I thought was really, really interesting. A couple of other things. Back to Buffett, he was asked about how the recent investments that Berkshire Hathaway has made, and Warren Buffett has specifically made, have been into capital-intensive businesses, while all through and through he's made references about why he believes capital-light businesses are the way to go to. And the answer was interesting because he said that they are buying into capital-intensive businesses because we aren't finding capital-light businesses at cheap valuations. Now take the clock back to what happened in the letter that they gave out to the shareholders, and Warren Buffett mentioned that he's not finding enough businesses at right valuations to invest in. And I know that a lot of argument is shifted towards buying into growth, into emerging markets, but this was with regards to US, because I think they made a number of references to how they will not look at emerging markets but look at US markets. But a throwback back to valuations and how it's becoming very difficult for the size of cash that Berkshire Hathaway is sitting on to make meaningful investments because valuations aren't cheap. So this was one reference to that I thought which was important to highlight. And as I said, they were asked about whether they would consider more investment opportunities into EMs if they had lesser money. I think the question was specifically from a Chinese investor and with regards to China, but I think he elaborated it to the emerging market pack. And Buffett said that there are opportunities to do with smaller amounts of money that we can't do, but our problem has been size, which is the pool that they are sitting on, rather than geography. So he said that there will enough that they will do if they had the money, but he made a clear distinction that he likes the laws of capitalism which are well defined, and he doesn't want to get into geographies wherein tax laws might change here and there, things that people like Ramdev and some ardent Buffett fans, Rajiv Thakur, who was there with us, also mentioned that they don't want to get into complexities, but he mentioned that he would comb through the US markets for opportunities if they are available rather than go into the emerging market pack.